Hi everyone, I'm the Tax Pro. This is day 6 of our 90 Days to Taxes series, and this is the partnership video for day 6. So every tax treatment has its own video for today because it is going to be different depending on how you're taxed. So this is the partnership video going over how you contribute money into a partnership, how you take money out. Okay, if you are not a partnership, you can visit the 90 Day to Taxes playlist, and that will show you your day 6 video for the way that you are taxed. So sole proprietorships, S corps, and C corps. Okay, this is for partnerships. So let's kind of do an overview about what I'm going to go over, because it's going to get a little bit jumbled, and we're going to kind of like come back to kind of one concept repeatedly, and then we'll dive in. So what we're going to be talking about is partnerships, how you put money in, how you take money out. But throughout this conversation, I'm also going to be talking about something called basis. And basis is going to get really annoying. You're going to get probably a little irritated with me about continuously talking about basis until it's going to kind of tie together at the end. So just try to follow the basis conversation. I think it's going to be easier to talk about the basis while we talk about each of these components rather than trying to kind of go back at the end and talk about basis. So when it comes to partnerships, each partner has something called a basis. Basis is really important because basis is going to tell us if you have additional tax due when you pull money out of the business. Okay, it is going to tell us if you have additional tax due when you pull money out of the business, and I'll explain that as we go. Okay. So I'm going to kind of talk about what basis is, how it's calculated, and how putting money into the business and all these other things impacts your basis, because they all kind of add or subtract from your basis, which can be kind of confusing. So let's first talk about putting money in the business. When you have a partnership and you put money in the business, we record that on the partnership's books as a partner contribution or into your equity account. Each partner is going to have an equity account, and I'll go over how to set this up when we go over chart of accounts, but each partner has an equity account, and that equity account is going to be increased when you put money in the business. So if you want to put money in the business for things such as like starting the business, or maybe there's additional funds that are needed, you would literally put money in the business. You're going to transfer money from your personal account to the business account, or write a check out from your personal account into the business account. The business will then deposit that. It is considered an owner's contribution or an addition to your owner's equity account. It goes into your owner's equity account. The other thing it does is it increases your basis. Okay, so this is the first component of your basis. Money that you put into the business is increasing your basis. Okay, so it does a couple things. Puts money in the business, it increases your equity account, and it increases your basis. You can just transfer money right in if you want, or you can write out a check. There may be specific protocols depending on your operating agreement on how you contribute money. Okay, so that's putting money in the business, just straight putting it in, not loaning the money or anything like that. It's just putting the money in the business. Let's talk about owner's pay now. So when you are a partner, you do not go on payroll. Okay, even if you're doing active work in the business, you're working in the business, you never go on W-2 payroll. You also don't get 1099s for your work, okay? So how do you get paid? There's a couple of different ways that partners get paid. One, they just take a distribution. So they take a partner distribution from the partnership that is, funds generally from the income of the business get distributed to partners. However, if you want to get paid in the partnership for the work that you're doing in or on the partnership, and there is no tie to the income of the business, so it's just compensation for work you're doing, it doesn't matter if the business has made money, lost money, etc., you would be receiving what is called a guaranteed payment. Guaranteed payments are interesting. They are kind of like payroll, but they don't go on a W-2. What ends up happening is the partnership will write you a check, or the partnership will transfer you money as your guaranteed payment. That way that guaranteed payment is calculated has to be in writing, and it has to be lined out in either the operating agreement or some form of, official agreement for the partnership, okay? And then that guaranteed payment gets paid to that partner, and it is a deduction for the partnership. It is considered an expense, so it is going to live on that partnership's P&L as an expense or a deduction. It is going to be deducted on the partnership's tax return, and then the partner that received that guaranteed payment is going to have it on their K-1, and they pick it up as income on their personal account. So it is subject to federal income tax and FICA taxes, okay? So pay tax on that. Guaranteed payments are optional, they're not required. What's nice about guaranteed payments is it doesn't touch your equity accounts, okay? It does not touch your equity accounts, which means that if you're 50-50 owners and you're doing work in the business but your partner just contributed cash, then you're still being compensated, and what you are pulling out for the work that you're doing in the business isn't cutting into that 50-50, your 50% share of the income. The other thing that's nice about it is not subject to basis limitations. So I'm going back to this concept of basis. Basis, like I said before, tells us when we pull money out of the business if we have to pay additional tax. But it does not apply to guaranteed payments. So with guaranteed payments, that additional tax doesn't come into play. Okay? Nice thing about guaranteed payments. Guaranteed payments do not affect partners' basis outside of the fact that it affects the profit or the loss of the business, which will tie into the basis. I'll explain that here in a minute. So it doesn't actively impact the basis outside of it becomes part of the profit or the loss. So that's a guaranteed payment. Other ways that the business partners can pay themselves and pull money out of the business would be by taking a distribution. And distributions are essentially the business paying its owners. It is not an expense on the business's profit and loss. It hits the equity accounts of the owners. So we have these equity, partner contributions, and then we'll have partner distributions, and each partner will have a distribution account. And it will go into that distribution account. And a couple of things happen. One, distributions reduce each partner's basis. Okay, so if partner A takes a $20,000 distribution, their basis is reduced by $20,000. And so it reduces your basis. However, your basis can't go below zero. If you take a distribution beyond your basis, you experience a capital gains tax. So in general, distributions from partnerships are not a taxable event. It doesn't matter if you pull money out. You don't get taxed on that distribution unless that distribution goes beyond your basis, at which point in time you pick up capital gains tax. Okay, so if that distribution goes beyond your basis, you pick up capital gains tax. Generally, distributions are not a taxable event, so guaranteed payments are taxable. Distributions are not, unless they go beyond the basis, okay, of that particular partner. So you can pull money out via distributions. Distributions are the standard way to pull money out of a partnership when you're pulling money out of, based on, you're taking a percentage of income. That would be like if you have a 50-50 partnership and you're like, oh, well, I get 50% of the income, that would be done via distributions, okay? So there's distributions. I'm gonna explain now a little bit more in depth how basis works so you can understand how that affects distributions. And then I'm gonna talk about loaning money to and from the business, okay? So basis in a partnership, it is generally calculated by the money that partner puts in. So each partner has their own basis. So it's the money the partner puts into the business plus that partner's share of income. So if it's a 50-50 partnership, each partner gets 50% of the share of income added to their basis, okay? So plus 50% less that partner's share of the losses. So if that partnership has a loss, then each partner takes their share of the loss and their basis is reduced by that amount. Okay? Then basis is also reduced by distributions. So for example, I'm just going to do a quick example. If you have somebody, like I've contributed $100,000 into this partnership, my basis initially starts at $100,000. And then that partnership makes $300,000 and I'm a 50% partner. My basis is starting at $100,000. I'm going to add $150,000 because that's half of the income. Okay? So now I'm at $250,000 in basis. The next year, the partnership loses $200,000. My share of the loss is $100,000, so I'm going to go from $250,000 in my basis to $150,000. I've subtracted my share of the loss. So now I'm sitting at $150,000 in basis. If I take $150,000 in distributions, that's not a taxable event because I have the basis to do that. My basis just drops down to zero. Okay? Now, if I take a $200,000 distribution and my basis is sitting at $150,000, I do not get taxed on $150,000 in distributions. The additional $50,000 beyond my basis, I pay capital gains on. Okay, I pay capital gains on that distribution. So that's how distributions work. Distributions in general are not taxable unless they go beyond your basis. There's some other things that factor into the basis calculation of partnerships. I'm not going to go completely into it today, but if you are personally liable for the debt of the partnership, you can add some of that, depending on the way that it's structured, you can add that to your basis, okay? So you can add that to your basis. Now, what about loans to and from the company, okay? If I want to put money into the business, but I want to be paid back for that, and it's not going to be a contribution, like a partnership contribution, it is a flat loan. You can do that. You can loan money to the partnership. It, however, has to look like a true loan, right? It has to be a true loan. It has to have interest. The partnership has to pay that partner interest for borrowing that money. Same thing with the partnership loaning money to the partner. The partnership can loan money to the partner, okay? There has to be interest assessed on that loan. Now, you have to be careful that a loan is not trying to get around the basis limitation that is put on distributions, right? So the partnership can't just loan money to the partner, never get paid back, never collect interest in order to get around the distribution, that limitation that's based on basis, okay? Be careful with that. Seen a lot of people that have come to us and all of a sudden they have loans on their books and that loan is to a partner and that loan just goes up and up and up and up and up. And I'm like, okay, well, you're avoiding paying capital gains on your distributions. That's not permitted. This isn't going to fly in an audit, right? So to summarize in a partnership, when you contribute money, it increases your equity. It also increases your basis. You can just transfer the money in, write a check, all that good stuff. There's kind of, in general, two types of ways that you pay yourself from a partnership. One is guaranteed payments. Guaranteed payments have nothing to do with the income or the loss in the business. They have to be in writing, and it is taxable to the partner, okay? It is taxable to the partner. It is a write-off on the partnership's taxes, but it is taxable to the partner that received the guaranteed payments. The other way is via distributions. Distributions in general are not taxable. They're not taxable events unless you go beyond your basis, in which case you're going to pay capital gains, okay? And then I should mention that distributions are not taxable because as a partner, you are taxed on the income or loss of the business itself, like your share of that income or loss. Doesn't matter if you take money out or not, So I've seen a lot of people say, well, I shouldn't be taxed because I didn't take money out. Doesn't matter. If you are taxed on the income or the loss, regardless of whether or not you pulled that money out. Okay? So distributions in general are not taxable unless they go beyond the basis. And then you can loan money to and from a partnership and a partner. However, it has to be a true loan. There has to be interest assessed there. And you can't have the partnership loan money to a partner, never get paid back, never collect interest to get around the basis limitations. That will not hold up in an audit. So hopefully that was helpful. That was day 6. If you have any questions, please let me know. If it was helpful, I would appreciate a like and subscribe. And I will see you guys tomorrow for day 7.